Absolutely. And what about pension assets? So I think you've helped expats look after their 401ks and also Canadian pensions. What would you say when it comes to those assets?
In Canada, for example, as you become a non-resident, pension assets that move into a locked-in account have the ability to be unlocked after 2 years of non-residency. But at the same time, the withholding rates, depending on the country that you're in, can be very beneficial and may be much lower than what the tax rate may be moving forward in Canada. Example, you can see someone someone that's deceased, you can see RSP tax rates at 54%. Or the withholding rate in Canada is 25%. So you want to plan those assets out. It may be very beneficial to leave them in, say, example, Canada, right? And defer the tax and let them grow there. But there's also regulatory issues with them. So there's a number of concerns that you at least need to talk it out and make the best decision individually. For some individuals, it's actually to pay the tax and to move the assets, out of the country, and then have clearer access with no future tax liability. And so we have to weigh the pros and the cons, of those pension assets. The other thing are on pension assets, there's abilities with tax, with tax filings as a non-resident back in Canada with those assets each year. There's the potential that if the withholding rate is higher than what they would have paid normally, you can get a refund under Section 217 of the Income Tax Act. So it may be beneficial to file in Canada. You never really know until you've met with a financial advisor that can take you through those steps to make sure that it could be advantageous to be able to do that.